Welcome to this video. In this video, I'm going to be doing a stock analysis of EOS Energy. Now, as you can see, this year has been amazing for EOS Energy. That is the green line right here. So we started out the year at about 5.62 and currently trading at 16.72. Now, I do think this price is actually quite justified because they're one of the only ones in the market making zinc batteries. They look like this, and that is, for example, when you have a brownout or a blackout, well, then you can use these battery packs to make sure you don't lose power. Now, they recently just made a deal with Pennsylvania, which is quite interesting. Now, as you can see right here, they made an agreement with Thailand Energy, which is a huge energy provider, and they also made an agreement with Pennsylvania, the state, of course, and this is a great idea because chances are every single state in the United States are going to have their own data centers, and then if you can have batteries on the side of the road or on sites with maybe solar panels and so on and so forth, it's great to have some energy stored so you don't see these huge blackouts, which is one of the reasons why it has skyrocketed recently. Now, if we take a broader look at the stock, as you can see right here, it hasn't been the best stock to own. As you can see, after it was first in public launch back in 2020, as you can see, it was about 13 bucks or so. Yep, right around here. Yes, about 13 bucks or so. Then it quickly skyrocketed all the way up to 31, and ever since then it fell quite far down. Then we did see this huge rebound back here, but ever since then it hasn't been the greatest stock to own. Now, of course, a lot of battery companies these days has taken huge rides upwards, like Dragonfly Energy is also one that has really taken some strides. But one of the reasons I like EOS is they're the only ones using zinc. Let me just make each candle an hour again. Now, if you look at the RSI in the stock recently, as you can see, it is quite nice. As you can see, we have been in the upper channel recently. And if you don't know what the RSI is, that is the relative strength index. This shows if there are more buyers or sellers in the market. Now, when a stock is below 50 and above 30, it's in the lower channel down here. That means there are more sellers or shorters in the market. We barely see that. We are almost always up here in the upper bracket. Now, above 50 and below 70, that means there are more buyers in the market, and this means there is an upwards going trend. And now we often see this as well in overbought. That is quite nice. Of course, the stock is more volatile when it's being overbought, but that means there's a huge upwards momentum. That is when we see these peaks. Of course, it's going to be overbought. As you can see right here, we see the stock price increase rapidly. Then we get into overbought. We see it right around here as well, as you can see, overbought. Now, we do see some oversold, like right here, but overall, it is primarily overbought, which is something that we love to see. Now, the stock itself is relatively small at $4.64 billion market cap, and we have a relatively low beta, which is nice. This means the stock isn't that volatile, which is something we love to see. However, in the earnings, that has been quite poor. As you can see, we miss it by quite a large amount of margins every single time, which is something that I would love for them to increase, of course. As you can see, they don't make that much money, of course. That is because, of course, it is a zinc-based battery, so of course it is in the early stages. So they make hardly any money at all. And of course, they need to make huge investments. That's why they have these huge losses. Now, if you look at the overview, as you can see, don't have that much debt, only $448 million, and the cash is about $152 million. Now, of course, a dream scenario would be that more cash than debt, but overall, a company like EOS, who has to, of course, invent technology, it is quite normal to have this amount of debt. Now, something that is quite nice is how little closely held shares they have. Closely held shares is shares that can't be sold in the free market because of a lockup period. It is usually a CEO or other investor. So it's very nice to see how much free float shares they have. Now, the price to sales ratio is relatively high at the moment at 105, and this is something that is often quite high in small companies like this who are seeing a huge write up in the stock price. If you look at it annually, as you can see right here, it used to be back in 2020 4,660. That is one of the highest price sales I've ever seen. So as you can see, it has been quite much lower. I mean, look at the late last year. It was at 66 and now we're at 105. So of course, if you bought back in 2022, of course it was much lower, but currently we are at quite high in price to sales. Now, if you roll on here and look at the seasons of the stock, as you can see, it is a bit of a coin flip stock. So if you want to buy this, of course, you should have your risk parameters in order. Now, as you can see, some years we lose quite a lot of money, and in years like this year and last year, we make a huge amount of money. So of course, that is nice, but we'll be very careful in stocks like this. Now, if you look at the average return on this, it is actually negative. The average return is minus 14%. So if you bought this when it was first publicly launched, you're sitting at a minus 14%. Of course, be careful in stocks like this. As you can see right here, we have no year with relative normal returns. That would be 2023. But overall, be quite careful in such small companies, especially ones who don't make any money yet, because it can go south very quickly. Now, if you look at analyst rating on this, as you can see, we have 3 strong buy, 1 buy, and 5 holds. Overall, it is decent. Now, the average price point is a bit down, but that is to be expected given the ride it has taken. Is it going to increase? It wouldn't surprise me, but it wouldn't surprise me if it took a breather and went down to maybe 8 or 9 bucks again. Now, annual EPS estimation, of course, it is increasing quite a lot, and as you can see in 2027, They're estimating to make positive on the EPS, which is very nice. And in their revenue, as you can see here, they're estimating to guide it upwards insanely fast, which is quite interesting to see. This year, they're estimating to make 146 million, but in 2028, 1.6 billion. That is an insane amount. That is more than 10 times their money in 3 years. If they can pull this off, it's going to be an insanely nice company to own. I have to say, I don't own any myself, but overall, it would be insane. Now, I have to say again, I do like it, but because it has risen up so quickly, it wouldn't surprise me if it took a breather. So maybe if it went about right around here or so, it wouldn't surprise me at all. It could, of course, also trade sideways, but taking a breather downwards, of course, wouldn't surprise me that much, as we might see some people just take their profits off, because everyone who bought down here, of course, are sitting at a huge, huge profit. Now, something, however, that is nice is the volume is not that great compared to what it used to be. Now, if you look up here, as you can see, the average volume in the stock is 23 million. Now, the current volume is 29 million, so it's really not a hype stock. So, of course, that is nice to see. Sometimes we see the average volume is maybe 10,000, 10 million, but currently it is 29 million compared to 23 million. So, this is a great signal that we're not in a hype cycle. Now that was my analysis on EOS Energy. If you like this video, please don't forget to leave a like and subscribe. And if you want to see more videos like this, please leave the company comments analyzed in the comment section below.